Stocks had a terrible 2018. In fact, almost all assets had a bad time throughout the year. There were only a handful which performed well, and this comes at a time when the euphoria over a group of tech stocks was at its highest. Amazon and Apple hit $1 trillion valuations. Then suddenly everything fell. Suddenly everything changed. Hundreds of billions of dollars were wiped away from these stocks and began finding safer and more diversified positions. So what is 2019 going to look like? You came here for the truth, so let me unveil that for you. Today we're going to look at what has happened throughout 2018. I want to show you what has been bad, what has been good. Going to give you some details, some technical indicators, some articles and charts, a lot to cover today. So let's begin by taking a look at this. Percentage of assets with negative total return in US dollar terms. You can see 93% of assets throughout 2018 suffered. That is the highest on record. This chart goes back to 1901. The data is provided by Deutsche Bank. You are looking at basically every asset doing terribly this year. If you want to know what has done well, I can tell you right now, it is the US dollar. Believe it or not, simply US dollars have done well, and that's because all of the other assets have looked bad. It's not necessarily that the US dollar had performed well, it's that everything else was falling against it. This shows you 2018 is a historically bad year. On the right hand side, you can see all of the different asset classes that fell into the red. You are seeing different years. This goes from 2004 up until 2018. Every single thing in 2018 seems to be falling, whereas you can look the previous years, there would always be good and bad, give and take. However, this shows us 2018 not so good. But everybody wants to know, what were the best investments of 2018? Can you believe art, wine, and cars seem to be very good this year? Who beat the market? Investors who like the finer things in life. Luxury assets including wine, art, classic cars, and fancy colored diamonds have outperformed stocks and bonds this year. People are looking for a place for their cash, and the security of holding something physical is appealing. They're looking outside of securities, and gold is not what it used to be. At least that's what they're suggesting here in this Wall Street Journal article. Luxury assets have outperformed stocks and bonds. You're looking at art and fine wine, that's the two green lines. Although classic cars seems to be in the negative, it's only by a small amount versus the S&P, for example, which declined quite a bit more than that. And then of course we have emerging markets and other markets around the world that perform even worse than that. You can see that there have been indexes formed over these last few years tracking all of the different asset classes, and for the most part they've all been performing poorly throughout 2018. All of these different ETFs that have been created have been performing rather poorly throughout 2018, particularly towards the beginning, and then there was a lot of turmoil throughout the middle of the year. But as soon as we got to October, everything around the world was falling off a cliff. Liquid assets, the price of fine wine has increased 10% in the past year. Can you believe it? Something like this has expanded by 10%, and that is a good return when you look at comparable assets. This article out of CNBC just talks about the different stocks that are out there, different companies, how well they performed, and so on. Apple closed almost 7% down for 2018, making for the stock's worst year of trading since the 2008 financial crisis. That comes after the stock passed a historic $1 trillion market cap as the first publicly traded US company to do so. The articles were coming out and saying how long until they get to 2 trillion and so on, and it wasn't long before it started to fall. Apple now trades well below the benchmark and at a lower valuation than Microsoft. Microsoft ends up the year as the biggest company. They get into more details, but I'd like to move on. You could see the winners and losers this year, 2018. Jeff Bezos, although he is obviously incredibly wealthy, his net worth grew about $24 billion to $120 23 billion, but even he was a loser in the second half of the year as stock markets were routed. From a September peak, Bezos has since seen his fortune drop $45 billion. That is incredible. The amount of money that has been evaporated. Well, a lot of his wealth is tied up in Amazon stock, and as a result, it came down by 45 billion. That is extremely huge. When you think about it, the amount that dropped off of his fortune is bigger than most of the richest people in the world. At the bottom of this page, they also talk about Mark Zuckerberg, who, although at the beginning seemed like he was on top of the world, his net worth fell by nearly $20 billion. He still has $53 billion, so I'm sure he won't be sleeping on the streets anytime soon. Then we look at the yield curve inversion that is taking place in just about every possible indicator. This right here is the 2-year less the 1 year, and it has inverted. There have been so many of these cases. What's interesting about this, just like the others, is that it's the first time this has happened since the financial crisis. They seem to all be doing this now. We are falling into the same patterns that have happened previously, that happened before that, and before that, and before that, and every time it happens to be a leading indicator of recession. So that could be a foreshadowing for what we will experience in 2019. Nobody knows when it's going to come. Nobody knows why it's going to come, but there are always these patterns that occur that happen to warn or really raise a warning indicator of what's happening. This article out of the Wall Street Journal is talking about earnings. A danger is lurking as the stock market dives. Earnings expectations are falling too. In December, analysts cut their earnings forecast for 2019 on more than half of the companies in the S&P 500. The first time that happened in 2 years. And at the bottom here, investors are worried the money-making outlook for companies will deteriorate further. Morgan Stanley now sees a more than 50% chance of an earnings recession in 2019, defined as 2 consecutive quarters of earnings declines compared with the year before. So there's a chart on that, and basically these are the previous instances where we have seen this earnings recession could actually come without an economic recession. That was 2015, the last example that we have of that. It just depends on the conditions at the time and a whole bunch of factors, but I wanted to show you that just very quickly. And then we have this: good times, bad times. An earnings recession is typically defined as 2 quarters of declines in the S&P 500 earnings per share compared with a year earlier, and you're just seeing that plotted out on this timeline to give you an idea of how this works. There's no telling when it could happen, there's no telling how this will unfold, but certainly it just gives us a good idea of what has happened in the past. This article is talking about hedge funds and how they've been brutally beaten throughout 2018. They actually compared it to the restaurant industry. They said where you find oftentimes that there's only a couple names that will outlast the rest. Most of them will fail. It's a tough environment to navigate. It feels like 2007. Money is flowing out of the hedge fund industry. Their estimates here, $12.8 billion of net outflows compared with inflows of $29 billion in 2017. Things have really changed. According to this quote here, investors are probably looking for a safe haven. Returns haven't been great, so there have been flight away from hedge fund strategies towards safer options. And they're even talking about, can you believe it, going back into gold. My goodness. Well, that's the hedge funds talk of the year, getting real shaky at this point as we begin 2019. The Eurozone is moving to stop printing 500 euro banknotes, and it goes on to talk about the details of that, but I just wanted to get into the issue that is explained in this Wall Street Journal article. Your cash is no good here, literally. The Cashless Society is a real thing. It's happening today in many countries around the world. Sweden happens to be the leader in that, but of course cash is still available, cash is still used, but more and more often they are going going to digital forms of transactions, whether that's using your plastic card or maybe your cell phone or other methods. There's the convenience factor, there's the potential security bonuses, that not having big wads of cash around with you everywhere, and that's obviously a positive. But the negative is where we lose in the ability to transact between two individuals without the knowledge of a third party. And that's not a small thing. That is extremely important. And that is the benefit of cash. There should never, ever be the elimination of cash. But of course, the businesses can decide not to accept it. They do not have to accept cash. But if an individual only has cash, well, they might lose that business. So let's see how the future really plays out here when we talk about currency. Now it's becoming zeros and ones on a computer, and it can be manipulated, controlled, and of course withheld at any moment. This has happened many times before. Look at what occurred in Greece just a few years ago and is still happening today. Individuals are unable to take their money out of the bank as they see fit. There are limited daily transaction limits, and that unfortunately is so painful. For years, being limited to the amount you can take out, that will really hurt a lot of people. And then last but not least, I just wanted to touch on this point very quickly. Teachers and other public education employees, such as community college faculty, school psychologists, and janitors, are quitting their jobs at the fastest rate on record. They make the suggestion in this article that people are trying to look for better opportunities. This has really changed because it tends to be public education employees that stay in these jobs for long periods of time, and they're rewarded for that at the end of their stay. This was actually really surprising to me, so I'm interested to see some more data on this in the future. I just think that we are seeing a lot of change. 2018 was a big change in so many different ways. The way I look at it is that 2019 is probably going to be even crazier. A lot has unfolded this year, 2018. As we begin 2019 here, we need to keep on our toes, that's for sure. A lot of things are going to be messed up, and whether or not we will see a recession in 2019, I know that there is going to be some curveballs thrown at you, so just be prepared. I wish you the best for 2019, each and every one of you. Thank you for watching. If you found this video informative, please give me a thumbs up. When you give me a thumbs up, you're supporting this channel, so I do appreciate that very much. If you found this video informative, I know you'll find my books, The Money GPS and my newer release, Global Economic Collapse, even more informative. You can flip through these books at Amazon. There's a link in the description of the video. If you're more interested in the audiobook version, you can get that at themoneygps.com.